Hello, everyone. Thanks very much for joining us today. Maybe we'll just give 30 more seconds for people to join in, but we will start on time. So thanks for all of you who have made it on time, so we won't keep you waiting very long. They're just people streaming in now, so we'll give them 30 seconds more. Thank you. Okay, great. Let's start. Again, thanks very much for joining us. Today we are talking about growing our wealth with SRS. Some of you may have seen our previous webinar, which was about more the how SRS works and what benefit you can have from it. Today we will actually be exploring the investment strategies that we suggest for you to think about with the SRS fund. So we won't go into the nitty-gritty of SRS itself, but there is a really great webinar which is available on YouTube that my colleague May ran a few weeks ago. You're always welcome to have a look at that if you want to get to know SRS specifically in detail and the construct of it. So I'm Nandini, I'm the COO at Stashaway. I'm also a licensed representative by MAS, and hence can share over here some material with you today. Just before we start, this is really meant for an educational purpose. It is not meant as a specific advice. We do have client engagement team. We have wealth advisors if you're an accredited investors that you can reach out for if you're looking for more specific advice on products and all. But today, hopefully, you will take away something, a clearer understanding of what investment strategies you can consider. But this is not meant to be individual advice or advice on tax. You all know whose webinar you joined today, but we are Stashaway. So we're today present across 5 geographies in Asia, Singapore obviously being our home base. So we are licensed by 5 different regulators, backed by some of the leading investors in the world. And we work with leading custodian banks like Citi, HSBC, and DBS to make sure that your money is always kept safe. So I will move to really the meat for today. So we are a one place to build your wealth. And so we do provide a wide range of investment products, starting from cash management to general investing, which are more risk-based, and for you to be able to build your own portfolios, to income, to thematic, and for accredited investors, alternative investing. What we will focus today on is really the cash management, general investing, income part, because SRS, these are more conducive for SRS investing. For thematic and alternative, those are not something that we recommend for a supplementary retirement scheme investing, and we'll go into it a little bit on why. So before we start, a very, very quick reminder, but as I said, there's a really in detail webinar that my colleague May ran a few weeks ago that is available on YouTube if you really want to understand the nitty-gritty of the construct of SRS. But what it is it is a supplementary retirement scheme that is offered by the Singapore government. It has a limitation on contribution, which is different for Singapore citizens and PR at up to 15,300 per year, and for foreigners up to 35,700 per year. And this is eligible to be taken out of your taxable income. So you obviously have it helps to reduce your tax within the year, but then, really build towards your retirement. So it's a really important scheme, that we recommend to all our clients, to take advantage of it. So in the short term, it helps you reduce your tax burden, but also helps you put something away for the long term that afterwards, can grow, which we'll talk about today. And then when you actually withdraw the money, there is a 50% tax benefit to it. So as I said, the main tax benefit is at the contribution time. There are two withdrawal requirements. So for Singaporean and PR, it's the retirement age, so 62, 63 years old. However, for foreigners, there is a 10-year lockup period, post which you are allowed to withdraw without any penalty. If you withdraw SRS before, there is a 5% penalty on early withdrawal. So again, we will talk about, how do you make sure that you put in money that you wouldn't need, and so you don't risk incurring an early withdrawal penalty. So before we talk about investment strategies after the contribution of SRS, actually there is a strong investment strategy that you can apply even while you prepare for SRS contribution. So when we're working on the preparation of SRS contribution, so by default, the way the scheme is set is you have until the end of December to make the contribution to get the tax advantage. So you have to move money into an SRS bank account, which in Singapore can be with DBS, OCBC, or UOB that you open. So you are not really required to move money anytime specific during the year. You just have to hit it before the end of the year to make sure you get the tax benefit on your bill. So, but if you think about it, is how you can really efficiently prepare for an SRS contribution is you can actually start to put aside on a monthly basis, which for a Singaporean PR to get the maximum benefit of it would mean $1,275, and for foreigners would mean $2,975 if you want to take the full benefit of the maximum limit allowed. What we suggest is actually you don't have to put it immediately into an SRS account because, as I said, there is a lockup for it. You can touch it in terms of investment, but you cannot withdraw it out without a penalty. But throughout the year, you can start to accumulate this money, in a liquid space without making the contribution to SRS, just so that you know that at the end of the year, looking at your financial situation, you can actually say, okay, I don't have any other needs. I actually can put this money away for the long term. And in December, you can actually, or November, whatever is preferable for you, you can actually trigger that transfer to the SRS bank account, which actually locks in the money. And so because you have this, in the year, you have this 12-month fixed time horizon for that contribution, there are two things to think about. One is to set a budget. So, if you're a Singaporean or PR, the 1,275 or 2,975. So you keep on putting that money away, but to not leave it in your bank account, because savings bank accounts in Singapore usually earn 0.05%. What you can do is already start to put it aside in an ultra low risk cash account. So what we mean by that is, throughout the year, you could be investing that money into something like Stashaway Simple, which is our cash management portfolio, which is ultra low. It is in money market funds. It's a liquid portfolio. What it does is that along the time in the year, you are able to make sure that you have the full benefit of it, and you can still decide at the end of the year whether you want to, move to SRS bank account the full 15,300, or actually you only want to move 10,000 this year, that's still an option that is open for you, but at least you have been accumulating that fund. And the second thing is, while you are accumulating that fund, especially in today's interest rate environment, you want to make the most of it. So, earning 3.6% per annum net of fees, throughout that time on all of your money put aside, can actually move the needle on overall, right? So at the end of the day, it's just making sure that that money that you're putting aside is continuously working for you. You can also use, fixed deposits. We have simple guaranteed where you have shorter tenor. So obviously we don't suggest the 12-month tenor because you will overshoot the contribution day. But you can use the shorter tenors, if you want to really go ultra low risk. So it's really important to actually have an investment strategy while you are putting this money aside. And what we suggest as an investment strategy, because you have a short 12-month time horizon, is to largely cater to it from a cash equivalent perspective. So not, going into more volatile products to not jeopardize the total amount that actually you want to make sure you end up with in December if you want to take full benefit of the SRS limit. So once you have, prepared your contribution and you have decided to make the contribution, then we really move into an investment strategy of long-term investing. And why? Because at a minimum, you have a 10-year scenario ahead of you if you are a foreigner. And, depending on your age, if you are still very young, in your 20s, 30s, you could have, up to 20, 30, 40 years ahead of you. That's a really long time to put your money to work. And again, if you leave the money in the SRS bank account, and I think the latest statistics still say that 1 in 5 Singaporeans actually leave the SRS money in the bank account, in the SRS bank account, and that earns you only 0.05%. So because at your withdrawal timeline, the tax benefit is that at that time it will be 50% taxed. So, you will have some taxation to pay on it, albeit really reduced. But what you want to do is that, the money grows over the time that is locked up in SRS, so that the actual burden of that taxation is lowered even more, because hopefully the growth in the investments cover for it. And we'll go through at the end some withdrawal strategies as well for SRS. So looking at, the time horizon that really exists, we really consider this a long-term investing. Also because, if you are a Singaporean, this is the first way, this is the second scheme actually after CPF for you to utilize to actually supplement your CPF retirement fund. And so the money in SRS should still be considered as a key part of helping you get to what you need for retirement. I think we all know, the current statistics that for most people, CPF money is not going to be enough. So, supplementing it with the SRS where there is a tax benefit ongoing and later on, obviously is a great scheme to take care of. But you want to make sure that, you're still thinking of it from the perspective of this is money you do need to count on at retirement. And why? Because at the end of the day, in any long-term investing, whether it's within SRS or whether it's outside of SRS with your cash, you still want to think about your goals, timeline, and risk tolerance as kind of a golden triangle that helps you, make the best choice of investment strategies. So here our goal is still retirement, and that's what we recommend, so that you can make sure that the lifestyle you want to retire with is more of a surety for your life. Timeline, as I said, we are really looking at here at 10 plus years of timeline for most people, and your risk tolerance according to that timeline. So if you're in your 20s and you're contributing, or even in your 30s and you're contributing to SRS, you still have quite a few years before reaching your early 60s. So, you do have a lot of time to think about what is the level of risk. And we'll go through a little bit how, markets perform. But you also don't want to overshoot on a risk, because this is not, this is still part of your retirement, or we suggest it to still be part of your retirement fund. And so there is a surety you want to arrive at. So now going, really into the investment strategy of how you, once you know this is your retirement goal, you have a timeline and your risk tolerance. The first thing is, we still want to make sure that there is a level of diversification. And, this is largely because asset classes rise and fall differently. So again, I'm not going to go into, what the different asset classes are and all. We again have, both in our app, in the Academy videos, we do have detailed videos around the basics around this. So if, you need to have a refresher on it, please do go and have a look. Otherwise, do share in the question Q&A as well. And I have two of my colleagues who will be very happy to also answer questions along the way or any clarifications. So at the end of the day, asset classes, they rise and fall, differently. They don't really go all in one direction. And so what you want to make sure is that your portfolio, according to your risk profile, is really catering to that. So if you are, on a conservative side, you will look for more fixed income, more for cash equivalent, especially in today's high interest rate environment, and, a smaller part of equities. Whereas if your risk tolerance is higher over the long-term period, then obviously equities can play a bigger role in your portfolio. It's balanced out a little bit by fixed income and commodities. And why do we really talk about diversification in every investment strategy is largely because you do want to keep your risk in check. And we'll talk about, what you can really look at for the S&P 500 or, those type of high return, high risk profile as well. And so what that risk reduction does is it actually smooths out a little bit your returns, right? Because over the long term, one of the biggest factors for you to actually grow your wealth is to stay invested. And like I said, SRS investment is not what is locked in. So you can move your investments. It's the SRS bank account which is locked in. So, just like any other investment, you want to make sure that your strategy keeps you invested. And so you have the right risk level for it, which you develop via a broader exposure, and also making sure that you don't have a concentration risk where, some asset classes can be very volatile, even though they have a very high return potential. So a really important part to know about the risk return profile of anything is that it's not a static number. If you are in consumer staples, or if you are in consumer discretionary, or you are in the energy sector, that it's always, the same risk and return profile. So actually, inflation and growth play a really big role in how the risk and return profile of each asset class moves. So just for everyone's benefit, at this moment, we are in a stagflation environment, which is high inflation and low growth, and a little bit inching towards the low inflation, and where do we land on the growth will mean whether it goes into all weather or recession. So not to speculate the direction of travel over here, but right now we are in a stagflation environment. So understanding, where inflation is and where growth is an important part if you are thinking about, building your own deep investment strategies. And this is a really good way to see. So for example, during a recession environment, we take three different asset classes. So the S&P 500, which is very heavy equities, US equities, the top 500 companies, then you have gold, which is a defensive asset, and then you have US government bonds, 20-year plus. As you can see over here, during a recession environment, low growth, low inflation, over the different economic cycle, in recession time, S&P 500 has, had a negative 10% rate return, whereas the other two asset classes, gold and US government bonds, actually did very well during recession time. During the good times, when there is high growth, low inflation, obviously, your US government bonds, because of low inflation, their return goes really, really low. Gold kind of has historically tapered off. But from a high growth environment, obviously, it's companies that are the top 500 companies in US, which are built on a growth vector, they obviously take the most benefit of it, of that environment, right? So historically, on an average, they have performed 16.4% positive gains during a high growth, low inflation environment. And similarly, during inflationary growth or during stagflation, different asset classes perform differently. And this is the value that diversification brings to you, where, as I talked about, smoothing out your returns, because at the end, you want to stay invested. You don't want to feel the really big volatile movements of a single asset class. In fact, I don't know if any of you have been following, but gold, I believe, this week has touched over $2,000 mark. So, that's a high for gold. And so in a stagflation environment, this is exactly what we expect, that gold as a defensive asset actually does really, really well. And this is, a very easy way to visualize. This is, what the return over the last, annual 40 plus years has really been. So you can see there is a very wide range for things, from emerging markets. They really have a high volatility. So they can go really high in your positive, but they can also go really negative. So those are the level of risks and that are involved in different asset classes. But then as you go down, you see to the less riskier asset classes going all the way down to bonds. There is lower volatility, but then your average return also gets to be a lot lower. So this is just to illustrate for you, just high return also comes with a high risk profile. So you want to make sure that your allocation for a goal that you have to reach for retirement is well balanced. So having looked at those pieces now, what are the ways in which you can actually, what are the opportunities that you have to invest, whether you want to use, StashAway or you want to do it yourself. So today, as I shared, that today we are in a stagflation environment, and actually this is what StashAway's average portfolio allocation looks like across the risk profile. So obviously, if you go to a more lower risk profile, there will be higher cash equivalent and corporate bonds and gold. Whereas if you go towards a higher risk profile, it will be more of US equities, global equities. But this is what, in a stagflation environment, an average portfolio allocation for a balanced portfolio would look like. And this is what we provide actually without you having to do anything. And so, like I said, at the end of the day, at any point of time, there is, one part is how the market is doing and all, but the second part is what is your own personal risk profile. So if you are somebody who, on a 10-year, 20-year time horizon are fairly bullish and you think you can ride out a lot more volatility, but really give yourself the chance to reach the higher returns, you can look at a higher global equities, US equities, or in general equities-based portfolio. Whereas if you feel, no, my risk profile is actually a little bit more balanced towards conservative, I don't like high fluctuations, it doesn't help me sleep well at night, then, you want to balance it more towards the different bonds, and there's government bonds, corporate bonds, and commodities and real estate. And so lower down the equities piece, which really creates a high level of volatility. The second part is, so earlier we talked about this risk-based, how much risk can I take? The second way of doing it is by asset allocation, which also caters to risk, but it caters to a risk in a little bit broader spectrum, which is, and something that a lot of you may be familiar with is, associating your asset allocation by, a bond equity ratio. So 20% equities, 80% bond is the conservative profile, whereas when you switch that over, if you are on an aggressive profile, then you will keep to 20% bonds and 80% equities, or even 100% equities. And that's basically you having an investment strategy, which is a fixed allocation strategy. I think a lot of us know about the 60-40 portfolio, which for the longest time has actually been a very, very popular portfolio for people to say, for the long term, I'm in a balanced portfolio, which is 60% equities and 40% bonds. I think 2022 was, and a little bit in the high inflation environment even today, but 2022 was really an anomaly where both bonds and equities actually dropped in tandem. That had not happened in the last 40 years. But most of the time, bonds and equities are not that correlated, so should be able to bring your risk level down. Having said that, we are at the moment, in a still high interest rate environment, which does have an impact still on bonds, but not as much as last year, where interest rate was really going up very fast. But, if you don't want to worry about, managing, okay, how is interest rate changing and things like that, you do have asset managers like us, fund managers like us, so either general investing in the Stashaway portfolio or general investing with the BlackRock strategy, which actually works behind the scenes to keep your risk balanced. And it's really a matter of what you feel more comfortable in understanding of the strategy. Now, let's come to, if you actually want to think about building your own portfolio rather than utilizing another asset manager to deliver your portfolio. In building your own portfolio, you still need to think about, what is the risk level that you want to cater to. And something that we do in our flexible portfolios where you can build your own portfolio is look at the asset classes. So, if you say, okay, I really want to be in more high risk portfolio of 80% equities, 20% bonds, whether you are all skewed towards US equities or you balance it with international equities will mean whether you are aggressive or very aggressive, whether you are split on geography, and that's a balance that's still important for you to look at. Do you want to arrive at the end at a risk profile which is balanced or aggressive or a conservative risk profile? And the way to build that is really look at, again, as I had shared, that different asset classes move differently. You want to look across the asset classes and see, the ones that are not heavily correlated. So usually equities and bonds and gold are not heavily correlated. So putting those three together in a portfolio reduces your overall risk and smooths out the returns. You could add real estate into it and you can even split it between geographies. So either US real estate or going to more international real estate. But this is where you need to do a little bit more understanding of what is the level of risk profile you are comfortable with. What we help you do is at least understand the overall risk profile of your portfolio. But obviously, if you have to reduce the risk in your portfolio, then what you want to increase is either the cash equivalents. And cash equivalent doesn't mean you're leaving your money in cash doing nothing. Cash equivalent basically means like US treasuries and all, which are very, very safe haven environments. Another way to look at it is, if you look at the broader market and what is available in the broader market for you to follow a market through the years, and this obviously means that there is a level of volatility that you can stomach. So for example, I'll pick from the number 2, which is the world index tracking. So the world index tracking template, or, if you take the MSCI world index, basically you are taking exposure to global markets. So you are diversified over geographies and industries, but you are staying fully in equities. So it is a high risk, but within that aggressive portfolio of equities, you are making sure that at an industry and a geography level, you are highly diversified. Whereas if you actually want to go more towards a lower risk conservative portfolio, if you think about passive income, which is largely a fixed income template, this is where, you are putting together government bonds, corporate bonds, and you can choose your own, allocation to it. And you can actually say, okay, I want to sit within the conservative profile, but I do want to make sure I take advantage of the high yield corporate bonds within it, but not move higher up in the risk profile than bonds. And then obviously today, one thing which, I think a lot of people sometimes are paying attention, but sometimes are not paying attention to, is that just because of the high inflation environment at a base level, the US Treasuries actually are at their all-time high yield. So US Treasuries at the moment are giving, 5+% per annum. This is an ultra low risk asset class to invest in. So again, if volatility is something that you really don't want to deal with, but your primary objective is to protect against inflation, then the US, the short duration US government bonds are actually a great place to park your money today. So you are still, making sure that you protect against inflation, but you're not taking any unnecessary risk. And these are all templates that you can kick off from, but, adjust them for your own either, where you want to be more invested, or, really focus on your risk. But we don't usually, suggest to go more narrow than this, because again, coming back to the fact that this money that you put away in SRS is really meant for a retirement goal. You want to make sure that there is a surety in you reaching that goal. So, investing it in a very narrow asset class like emerging market, which is a high risk, high return, but, it really creates a very high level of volatility that you want to really have as more as satellite strategy rather than a core retirement strategy. So from a core retirement strategy perspective, we always suggest to be either very carefully risk focused, either do it yourself, or, choose one of the stash away managed portfolios, or really track the world index. And that's a very low cost way as well of tracking the world index. But you have to be ready for a little bit of volatility in that, or really in the more conservative profile, look at fixed income and the USD cash yield, especially at this moment. Now, I think one thing, while we talk about from a very, very strong risk management perspective, I do think we have a lot of viewers, who are very young. And obviously, risk profile changes a lot depending on your age. So if you are in your 20s and if you are in your 30s, you have a very long-term horizon in front of you to take advantage of. And these are strategies you can also apply, outside of SRS. This is not just for SRS. And one of the things that, we do like to talk about with young people is just what is the value that simply the S&P 500 can provide you. So outside of a more, risk managed, well-diversified portfolio, the S&P 500 is still a time-tested, index which has historically always had a strong trend upwards. And while it comes with its level of volatility, as you see on the right side in the sector, split, today, a big part, or 28% of the sector comes from information technology, which is, actually all of your Apple and Meta and Google. But as you can see across the industry, it's a fairly, staying in equities, obviously, because this is top 500 companies. Across the sectors, it is a fairly well-balanced index. And so if you have a really long time horizon, you do have actually the option and opportunity to simplify in your diversification and not make it too complicated if you are okay to deal with the volatility. So if you look at, there have been, periods of bear market that the S&P 500 has dealt with. There have been, dips. Obviously, here I'm showing over a long-term trend, but you can see where, the dips have been. And we know last year the S&P 500 fell, or in 2008 when it fell, but it has always recovered. And the key goal over here is that if you have, 20-year plus horizon, even a strong ETF index like S&P 500 actually does give you a fairly good diversification. What you need to keep in mind is the volatility that comes with it. But over a 20-year horizon, I think the S&P 500 has delivered on an average, double-digit, early double-digit growth year on year on an average. So, that's a really good return, but you need to be able to stay invested in it. So it's really important to think about what is really your risk. If your risk profile, if it's going to keep you awake at night to see the volatility of the market, then in a long-term investing, while you want to lead with equities, you do want to supplement it with some fixed income, some gold, and some cash equivalents, especially at this moment, because as I said, of the high yield in the US Treasury bonds. So, and that's the way to, just reduce down the risk of the equities. The second part is so far we have talked a lot about global markets, and most of them are managed in the USD denomination. But we also have, quite a robust Singapore market. And, sometimes people do have a closer home bias. Not to, look at, we don't always suggest to have 100% home-based portfolio, but, the home base is always one that we understand the most, and therefore we feel comfortable through the volatility of it. And especially in Singapore, in SGD denomination, you actually do have from very conservative to moderate, and then, obviously you can go in more aggressive by actually being in only in equities. But the reason why we don't suggest in Singapore exposure to actually go very high, like in aggressive or very aggressive, because you not only have an equities concentration, but you actually also end up having a country concentration. And so that starts to, narrow down. You start to increase your concentration risk. So in an SGD denomination, we actually recommend more up to the moderate level. So, you have Singapore on a very conservative level, you have Singapore savings bond, you have money market funds, and, you also have within Stashaway the product that actually utilizes money market funds and enhanced liquidity funds to give you a very stable yield in simple and obviously simple guaranteed where there is absolutely no volatility. But then you also have a conservative profile where the key focus is capital preservation, a low risk exposure, and the emphasis is on income generation. And that, in Singapore, you can look at Singapore bonds and adding in some corporate bonds from Singapore we bring it all together in a product called Simple Plus. So it stays still in a conservative, low risk environment, but there is not a the income generation is more from a yield to maturity perspective. So you want to have, again, a little bit longer time horizon for it, not a very, very short time horizon. But again, looking at a portfolio that is a mix of government bonds, corporate bonds, can give you within Singapore a conservative portfolio. Then when we move to a more, moderate level risk, where obviously the approach is to really have a balanced risk return profile and mix, yield generation with some growth oriented assets. This is where in your bond portfolios, you can actually add, some level of equities exposure in Singapore as well as REITs. So, either looking for income funds or looking for balanced funds that actually take the bond, REITs, and equities piece in Singapore, which are really the three cornerstones of yield and growth in Singapore. So you have yield from the bonds, you have yield also dividends from the REITs and equities, but you also have a growth opportunity in them through certain, economic cycles. And we provide that in the SGD income portfolio as well, which I believe at the moment is 70% Singapore bonds, again, because of the great yield, and then balanced by a REITs and an equities exposure to still keep a risk return profile at a moderate level. So, you can look at between your choice between, a USD exposure product. So you have to know there is the FX part in it. But obviously, over the long term, the global market or, US market and even to the S&P 500, it overshadows any FX impact, but still something to be aware of. Or, if your profile on the FX side is more conservative, then, you want to stay within the conservative and moderate space and to not go to concentration risk in a single country and within equities. So now that we've talked about, the risk-based strategy, the asset allocation strategy that you can have, or, if you're young today, you have 20 years plus horizon, even simplify on it. There is also the second part of it, which is SRS withdrawal strategy, something that is really important for people to know. So withdrawals are allowed, as I had said earlier, for Singaporeans and PR after the retirement age, or for foreigners at 10 years. But you have a 10-year period to withdraw. So because at withdrawal, whatever you withdraw, 50% of it will be taxable. So you get an upfront tax benefit. And when you actually withdraw the money, only 50% of what you withdraw will be taxable. And because you have the time period of 10 years, you actually want to pace it out rather than withdrawing everything in one go, because this will go on top of your income bracket. So if you withdraw after your retirement and you no longer have, an income coming in, and let's say you withdraw an amount of $40,000 every year, which means $20,000 will be the taxable amount. But because the first $20,000 falls below the tax bracket, you actually have a zero liability. Obviously, you need to check, how the tax brackets are moving along in the years, and this can change. But, or, even if you are withdrawing 30,000, but if you don't have any other income, you actually lower down your overall tax burden because the first 50% will be non-taxable. So it's important to think about what will be your withdrawal strategy to take full advantage of this 10-year timeline to, at the end, holistically have a great tax benefit around it. And during this time, as you are, so even if you are starting, even if you have only 10 years ahead for your SRS money, either you will reach the retirement age, or, you're a foreigner and you actually want to take it out, you actually need to think about that not all of your money will come out on day one. And therefore, your money can still stay invested in whichever investment strategy you have picked. And so you can think about like, okay, actually, a large portion of my money is going to be invested for 15 years and not just 10 years. And so it's good to think about the time horizon along with your withdrawal strategy. Obviously, there is full flexibility available for you to withdraw as much as you want after the statutory period is over. And that, if suddenly you do have a need for it, that is available. So, but I think it's really important to make sure that you think about your withdrawal strategy and your pre-SRS contribution strategy, because this is still money that can be optimized to generate returns for you, that can be optimized to manage best the lock-in period as well as the income period. So again, like I said, there are a variety of investment strategies that you can deploy. At the end of the day, for any long-term investing, the first thing to remember is that SRS is a long-term investing because you have a 10-year plus horizon, and you should think about how to take advantage of it, but think about your risk profile in a very concrete manner. And so, whether you sit at an ultra low risk profile, and today, in the cash space, equivalent space, the yields are quite strong. But, if you want to move into the market, make sure that you take a more balanced approach, or even if you can afford a little bit higher risk, still make sure that you are taking a strong risk-based decision, because what you want to do is stay invested and continue to, contribute to SRS every year to get the best benefit to your taxation, as well as to supplementing to either your CPF or any other pension scheme that you may be utilizing. And so, we don't go into the thematic space for SRS. As I said, this is still money meant for retirement. And so this is really the place where we think about a surety at the end of the day. You want to be able to count on this money. This is not for satellite level strategies. You can use those type of narrow exposures, or where you really believe in something more for your cash and managing the allocation to it in a different manner rather than a core part of your SRS. So either 15,300 or 35,000 plus every year. That's quite a big contribution to make towards your retirement every year. So that's what we have for today. I know it's a little bit broad stroke, but it's really, I hope it helps you, just think through like what your choices are, and, still thinking about how you want to approach your risk and your timeline. If there are any questions, happy to take that up. I see a few questions in the says, is the simple guaranteed capital guaranteed? Yes, simple guaranteed is capital guaranteed, and the risk is the underlying bank risk. So the underlying investment is actually into bank fixed deposits. So it's only the underlying risk of the bank, but we only work with MAS regulated banks. So there is a surety over there for you. And I think another question is, if I plan to withdraw from my SRS after 10 years, let's say in the 11th year, should I still think about contributing to SRS? Additionally, I'll be leaving Singapore in the 5th year. So if you are leaving Singapore, you have to remember that there is a tax regime also in the country where you will be living when this money comes out. And, if overall the tax regime still makes sense for you, then yes, continue to contribute. However, if the overall tax regime, so the tax benefit that you get today and what you will have to pay at withdrawal, you need to do that math with a tax advisor. But if you are in a jurisdiction that does not tax worldwide income, but only tax country-based income, then obviously in Singapore, you will still have the same tax benefit. So you need to think about which country you are going to. Okay, I've been told there are a few other questions in the Q&A side. So if I'm a foreigner and I withdraw in the 11th year, will I be taxed? Yes, if you are in Singapore, you will be taxed on the you will be taxed according to the regime as I shared. So it will go above your income tax. So if you are earning an income in your 11th year and you withdraw, 50% of it gets added to your income tax. So you want to maybe manage that. But if you are outside of Singapore, then you also need to look at the tax regime over there. Can I split my SRS investment into segments, some dollar on general investing and others? Yes, absolutely. So SRS, once you move the money to the SRS bank, after that, you can split it into investments within Stashaway, outside of Stashaway. You can do whatever you want. It should be allowed everywhere for you to even move within investments. Certainly in Stashaway, you don't have any limitations of moving your funds around. So yes, so if you say, okay, I'm gonna put 50% into general investing or based on my risk profile, but I'm gonna put 50% into S&P 500 because that's the level of risk and you can split it as you want. Yeah. If I'm a foreigner and I leave the country, will I be taxed when I withdraw SRS? Yes, in Singapore, you will still be taxed on the 50% regime. And then, like I said, where you are in the country, you need to look at it. Yeah. Where can I access the presentation slides or recording? I believe this will be on YouTube. So you can access this on our YouTube channel. I think should be available in the next couple of days. Great. If there are no other last questions, then I'll close here. I know my colleagues also responded to quite a few questions in the Q&A during the webinar. But please, if you have any follow-up questions, you can write into our client engagement team. We're quite responsive, either on WhatsApp, email, whatever you prefer. And we're happy to answer any further questions around SRS or the investment strategies over here. Also, if you have any feedback on what more you would have liked to see in this, happy to take that feedback, develop that content, and bring it back to you fairly quickly. Just remember that what you need to do before the end of this year is move the money into the SRS bank account to get the benefit of the tax. You do have time to make your choice of the investment strategy that does not have a end of year clock ticking on it. So once it's moved to the SRS bank, you have the time to make your choices on the investment. So do let us know, what else we can help answer, to help you put your SRS to better use. Thank you very much for joining us today. And thanks very much for my colleagues to help out. And look forward to seeing you all in the next webinar.